Hello everyone and welcome back. Now, I recently tied XDIV as well as VDY in place for the best dividend funds in Canada. And I've already done an in-depth look at VDY. I'd love to do one for XDIV as well and go over exactly why I put this in the top position and how I think it's going to perform, what it does. By the end of this video, you'll have your complete due diligence done on XDIV. So here we are on the main fund website that BlackRock has themselves. We're always going to start on the main fund website because we want the fund to speak for themselves. We want the investment firm to speak for themselves. So what does BlackRock have to say about XDIV? Well, it is a low-cost portfolio of Canadian stocks with above-average dividend yields and steady or increasing dividends. Perfect. Low-cost, above-average, and increasing dividends. Music to any dividend investor's ears. Select securities with strong overall financials, including solid balance sheets and less volatile earnings. This one follows what's called a quality index. The title of itself is XDIV, the iShares Core MSCI Canadian Quality Dividend Index. And we're going to get into quality factors in a little bit, but this is why this fund has performed so well, especially over the past couple of years in these rather interesting investing times that we're in. And finally, designed to be a long-term core holding. This is going to be much more foundational. So something that you can buy and hold forever. Perfect. Love everything about it. As in whether you would be a dividend investor or possibly looking for future income. So investment objective seeks to provide long-term capital growth by replicating the performance of the MSCI Canada High Dividend Yield 10% Security Capped Index net of expenses. We're going to have to take a look at that methodology itself. So let's take a look at what that methodology is. How does a stock make it into the index, and what exactly does a quality factor mean? So the MSCI Canadian High Dividend Yield 10% capped security aims to represent the performance of equities in the MSCI Canada Index, excluding REITs, with higher than average dividend yields that are both sustainable and persistent. Perfect. That is what I personally look for when I'm investing in companies and reading over financial statements myself. I want to see how sustainable they're going to be over a long time period. I want to see how persistent they're going to be. I want to see, and these are very good indicators of growth of a company as well as how their future is going to perform. So I love that this index is screened specifically for them. So the index applies quality screens and reviews past 12-month performance to exclude stocks with potentially deteriorating fundamentals that could force them to reduce or eliminate dividends. The index is free float adjusted market cap weighted with a capping applied at the security level. So now we're going to have high dividend paying stocks, which are going to have consistent and sustainable and persistent dividends going forward, and we're going to market cap weight them all. Perfect. This is all just going through the rest of that. We'll continue down, but what is exactly a quality factor, and why would we want to invest in one? So here we have, directly taken from the MSCI website themselves, their factor investing PDF. So let's go through it together. Factor focus, quality. In the realm of investing, a factor is any characteristic that helps explain the long-term risk and return performance of an asset. MSCI indexes are designed to capture the return of factors which have historically demonstrated excess return over the long run. So there's tons of different factors. There's actually a dividend factor as well. There's a momentum factor, there's a low volatility factor, etc. and so on. There's I started off with 5 major ones, and there's actually hundreds of them that exist now if you want to break it down into the nitty-gritty details. Quality is the one which always catches my attention and makes me want to like it, because they always encompass what I am looking for in a good investment vehicle. So let's go through this together. And we can actually define and break down what a quality investment is. Love it. So, defining quality. The quality factor is described in academic literature as capturing companies with durable business models and sustainable competitive advantages. Quality is categorized as defensive factor, meaning it is tended to perform during periods of economic contraction. Talk about 2023. As well as the quality factor helps explain the movement of stocks that have low leverage, stable earnings, and high profitability. Perfect. Exactly the type of companies that we as investors want to own. The MSCI Quality Index employs 3 fundamental variables to capture the quality factor. Return on equity, which shows how effective a company uses investments to generate earnings growth. Debt to equity, a measure of company leverage, and earnings variability, how smooth earnings growth has been. Why investors have used quality strategies. So the long-term outperformance of quality factor against the market is well documented in financial literature. Nobel laureates Eugene Fama and Kenneth French, those 2 cats from the early 90s. Those were economists. They originally started off with a 3-factor model. Going into a bit of the history of it. Size, company value, and market risk to add 2 quality-related axes, profitability and asset growth. All right. But yeah, so essentially what we're looking for is companies which have a steady return on equity, which have steady earnings variability, and very low financial leverage. And as we can see from this chart, dating back to December of 1999, world quality versus the world index has solidly outperformed. A little bit of the, I guess it was in the lower end of the pack in early 2000s after the great financial crisis. It has steadily increased. Undoubtedly due to world debt ratios at this point. So many governments are so heavily in debt. We really do live in a different investing world now, and that's why I enjoy these quality indexes. Not to mention they're low cost. We haven't even gone through the rest of the website, but I do want to go through at a quality adjusted risk. So perfect long-term performance I wanted to get here. So as we can see, the World Quality Index, we have much lower risk, but we have very high profits as well, cracking around that 7%. The only is the World Enhanced Value, another factor investing. However, I go for quality myself. That's much more of a defensive factor. Although factor strategies have exhibited long-term outperformance, in short-term, factor performance has been cyclical and generated periods of underperformance. Absolutely. So these different factors will perform differently in different sectors, in different environments. Many active strategies have emphasized quality growth as an important factor in their security selection and portfolio construction. And so we see quality, basically what we were looking at across the board before. Generally good performance, very low in the early 2000s. 2022, it didn't do nearly as well when there's a lot of money sloshing around. If we're going to see 2023, we had done quite well. But then ever since the great financial crisis, it's been trending upwards and outperforming a variety of other factors. Conclusion. So, the quality factor aims to reflect the performance of companies with durable business models and sustainable competitive advantages. This is achieved by targeting companies that tend to have high ROE, stable earnings, and strong balance sheets with low financial leverage. Institutional investors consider quality for additional sources of return and/or diversification purposes. For us, retail investors, we are not too worried about that for diversification. We just want the best returns available to us. Quality has also traditionally served as a defensive factor when flight to quality occurs. So it's Essentially, you want really good companies that are going to be defensive. Let's continue on down the website and see how it's actually done. And we can see on a 5-year return, boom, 11.6%, 3 years, 14.45%. It's a very, very impressive returns over those times, even in consideration to other dividend paying funds. We'll be taking a look at those shortly. Now the distributions itself. Let's take a look at the dividends, everybody's favorite part of a dividend fund. And we can see they're rather steady, actually. So 10.3 cents going back. We have a slight increase up to 13 cents in January of this year. Going back 10 cents, slight increases. Now, this is not an income fund because there is some fluctuation, and some variability inside of the fund itself, or inside of the distributions itself. However, there is a steady uptick. So wonderful as a supplementary income if you are a very tight budgeter and are relying on a strict budget every month. Perhaps not the best option, but as far as dividend funds go, this is a solid pair. All right, and as we see, I'm not the only one who has this opinion. Over $988 million under assets, almost $1 billion under assets, which with an inception date of back in 2017, halfway through the year, quite impressive. Now, also looking at the screen, we're going to see number of holdings, 17. There's only 17 holdings in this fund. There are, unfortunately, just not that many quality companies out there. So this is a good way of getting a selection of them. And here we see, with a distribution yield of over 6%, just over 6%, solid. Even right now, as I'm recording this, stock valuations are at all-time highs. If you were going to buy in as a long-term investor for something, for someone who, or if you're going to hold this for 20 years plus, I would still invest. And there, fees. Okay, management expense ratio of 0.11% and a risk indicator of medium. Now, we're going to get down to the fees right now. Actually, let's do that first before we go through the actual holdings themselves. The best way to get the actual fees or what you're going to be paying for the fund is in the ETF fact sheet. Don't go anywhere else. This is where they show all of the actual fees that you're paying. So keep on scrolling down and we see, okay, so there is a management expense ratio. That's where the 0.11 is that they advertise. There's also a trading expense ratio of 3 basis points, giving a total expense ratio of 14 basis points. Now, this is still extremely, extremely cheap. Just to be aware, it is 14 basis points, not 11 basis points. A little bit tricky. Okay, going back up, let's take a look at the holdings, and we're going to go through all of them because there's only 17 of them. And as this is a Canadian fund and as this is a dividend fund, we're going to expect this to be extremely heavy on financials, on energy, on utilities, and a little bit of communications inside of there as well. Probably nothing else, as those are generally the biggest dividend payers, and Canada is exceedingly heavy on financials and energy. But let's take a look. And right off the bat, boom. So Manulife, we have one of the biggest life insurance companies out there, top 4. They also have a strong international presence. Royal Bank of Canada, it's the biggest company in Canada, massive bank. Pembina Pipeline. So they are not an energy producer, they're a pipeline, so they are a midstream, so very, very stable as well, and they have a steady dividend. Sun Life, so here we have a second life insurance company, another of the big 4 out there. And right after that, Toronto Dominion. Now, I like this as an investment on its own. TD Bank, they have a lot of American exposure, and I expect them to perform exceedingly well in the future, or to continue to do so. They're a good company as well. Makes sense why they're on the list. Fortis BC is a necessary gas supplier. It's part of the utilities and is needed for the needed for the infrastructure. Suncor Energy, so they own Petro-Canada, Now, I believe they did have a dividend cut within about 2020 during that March excitement during the pandemic. However, they have reinstated their full dividend. Emera, utility in a company, Great West Lifeco. Here we have three of the 4 life insurance companies. And boom, finally, 10th on the list, we have TELUS. TELUS are one of the big 3 communication companies in Canada. Canada is exceedingly oligopolist when it comes to our communications and a lot of our utilities, actually. So there's not that many options out there, period. That's why we have such high fees on them. Now, Canadian Tire Limited, I was a little bit surprised to see this. However, they are a very large and well-established company. They have a lot of, they own a lot of different places as well. I think they also own Best Buy or what have you. There's a whole bunch of them. It's a conglomeration at this point, and they are a solid payer. Keyera, another energy, no surprises there. London Mining, a little bit of diversification there inside there. Quebecor, we're back to communication, which is inside of Quebec, their main communication hub. Canadian Utilities, communications, a little bit of financials, IGM Financial. I'm not too familiar with them. I'm gonna have to take a look at them at some point. But that's it. That's all 17 that's on the list, and we see that it is, the last 7 that we have down here really don't account for much at all. It's really this the top. Oh, let me see. 1, 2, 3, 4, 5, 6, 7. Top 7 holders are going to have at least 8%, pushing 9%, pushing 10%. And that's going to be 2 of the best banks, or 2 of the best investment companies, or 2 of the best banks out there, when Canada's known for its banks. 2 of the best life insurance companies, and Canada is known for its life insurance companies. Exceedingly Pembina, an energy company, a midstream that has a very good timeline and a needed utility. This is a very safe fund. I like this one a lot. Scrolling down, looking at the sector, financials 44%, energy 21%, utilities 16%, communication 10%. Not much diversification there, but for the people who are investing for long term and trust the quality factors of an index, this has been an exceedingly good performer. Let's take a look at that performance now, actually. Going all the way back to when this fund launched. I put this up against several other competitors. So we have XIU, this is the S&P TSX 60. VDY, which is Vanguard's dividend fund. Now, I ranked Vanguard as tied with XDIV for the best dividend fund in Canada. So I want to put this one as comparison as well. And we can see that had you invested in both at the same time, you'd have almost exactly the same returns. Less than 1% variation. Now, XIC, this is the total Canadian index. So you would have everything that is inside XDIV as well as everything that's across the market. And then XEI, which is a very popular high dividend fund, also run by iShares BlackRock. I see it mentioned on forums all the time, and it is very, very popular and people like recommending it. I like XDIV better, and as we'll see, the returns have been much more solid. Now, I've also put ZWC down there. This is a high dividend covered call fund. So that means it's going to be writing covered calls. I'm going to have to go through and make an episode on covered calls at some point. But they're going to have higher expenses and they're going to limit the upside of the fund. So you are going to get a much higher dividend from it, but the overall returns will be lower. They can be good for people switching to retirement, but they are not great investment vehicles for everyone, to say the least. So let's take a look at a 5-year return, and we see VDY and XDIV, the one we were looking at today, has solidly outperformed all the other competitors on the list, with VDY coming in close behind and even outperforming the S&P TSX 60 and the total market index. Now, let's kick this up a little bit to July 2019 just to give us some more returns, and we can see basically the same thing. VDY and XDIV have swapped places. This is why I put them as tied. Now, I really enjoy looking at January of 2020 because this is when we entered a really new investing environment, and it's interesting to see how things have performed since then. And we see XDIV comes out in the solid middle of the pack, followed by next up is the TSX 60, and then Vanguard takes the win. But once again, you would have been doing better off inside a registered account if you were buying this than XIC. Definitely better than XEI, and definitely better than the covered call fund in last place. Just for funsies, let's take this up to March. Get a real exacerbation of it and see, yeah, exactly the same numbers we see there. Inside this new investing environment, going for dividends that are quality and buying the TSX 60 and even the stock market as a whole has outperformed a broad-based dividend investing. Vanguard's fund is much more heavily weighted towards financials. I think it's well over 50% inside the financials, and the reason that is because they are some of the best companies and investments out there. It's unfortunate there aren't more of them, but it is what it is. All right, moving up to July of 2020, taking a look at these returns, and we see surprisingly XEI has come in on top, but VDY and XDIV right underneath it. We see dividends have done quite well during this time. Everything else is underneath it, but ZWC still in last place. All right, going up to January of 2021. Boom, XDIV taking the lead, followed by VDY and XEI under there. Hey there, it's done in the middle of the pack. Nice to see it not falling at the complete tail end. However, XIU and XIC are still, well, I guess they're at the bottom there. This was a weird time. There's a lot of money floating around at that time. XDIV certainly would have done well for anyone who was an investor. Taking a look at January 2022, so returns for the past 2 years, we see XDIV coming out well on top. Really not a surprise anymore. All of these basically line up in the same spot. And then finally, going into 2023, so 1 year of returns. I guess I can just click the 1 year button. But boom. XDIV has been the winner over the past 2023, with interest rates being a little bit funny, followed by XIU, XIC, VDY, and XEI underneath there, coming in last place underneath the covered call fund for the very first time. Either way, throughout this, we've seen VDY and XDIV solidly and consistently outperform XEI over almost any timeline. We've seen ZWC come in at the covered call fund, consistently coming in last place. And we see the TSX 60 and the total market index coming in somewhere around the middle. If you are inside a registered account and if you are a dividend investor, XDIV is an excellent investment for you. All right, leaving that page, and finally let's just take a look at the price history of it. So we can see, even if you had been a holder at the absolute peak back before the 2020 crash, you'd been 23 and 20 cents. You'd have returned. It would have taken a little while to get back there, but by a little over a year, you would have had, if you had just held, not done anything else, about a year and a quarter down the road, you would have had your stock price back in place, and you would have been collecting dividends that entire time. Hopefully being able to reinvest them during this spot down there. But this has been a very good one to hold forever, in perpetuity. Just enjoy the dividends as they come in, or you can count on some capital appreciation. And finally, I like to look at the conversations in Yahoo Finance just to see even though if there is any intelligent life out there and what it is saying about it. So TER3. This is by far my favorite ETF. Solid companies, good dividends, low MERs, reasonable volumes. Agreed. However, do not rely on Yahoo Holdings. Yeah, definitely not. Always go to the fund website itself. Nice dividend, says M. I agree. It's all a solid 6%. Tanger says, afternoon folks, XDIV.to. Is this a good time to start a new position in my TFSA or RRSP? Yeah, any time is a good time to start buying into this. Acquire more when the price is down. Yeah, you're laughing. It's regrettable that Yahoo Listings top holding is incorrect. Yeah, don't go to Yahoo Listings. We're just here for funsies and see what you have to say. Remember the good old days when we used to invest to make money? Thank heavens Ottawa has cured that problem. Yeah, that's more of a global issue at the moment. Take your politics out of here, man. We're investors. We work around it. Is this the same guy? He's posted like a bunch of different times up there. One of the best ETFs on the TSX. I agree. I solidly agree. It is one of the best ones that we have out there. Probably in the top 15. Really, you don't need that many funds in order to have a very optimal portfolio, no matter what your needs are. It's a matter of selecting the right fund for you. Back here to say, it's still one of the best ETFs on the TSX. Let's go XDIV, never selling this baby. I agree. Angela, yes, pretty good. They'll have to think about a rebalance as Nutrien now greater than 10%. Yeah, that's the best thing about owning a fund. You don't need to do any of the thinking. That's specifically why you would buy a fund. It's to have the professionals do the matching of the index for you. Perfect. All right. So now we've gone through everything there really is to say and know about XDIV. So if you hold this fund, good for you. This was a very solid investment and you've made a very good decision. Now, if you hold XEI or you hold ZWC or you hold something else on the list, it doesn't necessarily mean that XDIV is the best one for you or that you've made a mistake somewhere. It matters about playing what your cards are correctly. Now, I love this fund. I invest in it myself. Personally, I split my money between VDY and XDIV if I am looking to invest in dividend funds. However, I'd love to hear what other people are saying. This is a very popular fund and I'm interested in your thoughts on it. Remember, if you are investing in your money and you're pushing for a better future, you are doing better than 99% of your colleagues and contemporaries out there. You should be proud of yourself because it is an exciting prospect to make a better life for yourself and to take control of your finances and to ride the tiger, as Julius Evola would say it, to really take control of your own fate. And you are doing a fantastic job and I'm proud of you. Keep going, and I'll see you next time for another ETF review, or maybe we'll do an ETF fight where we'll see which one is the best in the sector to buy for whatever your investment needs may be. And until then, I'll catch you later. Bye for now.